the collapse that created modern capital. It did not feel historic in the moment. It felt like confusion. Orders unanswered, payments delayed, confidence thinning hour by hour. London had seen disruptions before, but this was different. The machinery that moved money itself had begun to seize, and no one could agree where the failure truly began. The city was operating at unprecedented scale. Credit layered upon credit, obligations linked across institutions. Capital flowed not as coin, but as promises stretched across time. This complexity delivered growth few generations could have imagined, but it also created fragility hidden beneath efficiency. When one piece failed, the stress did not stop. It traveled. To understand why this collapse mattered, we must return to a moment when London believed it had mastered finance. Risk was priced. Trust was systematized. Information moved quickly. The city appeared resilient. Yet beneath the surface, capital had become tightly interconnected. Strength depended on continuity. Stability depended on belief. The reveal came quietly. A respected institution missed a routine obligation. Nothing catastrophic, just a delay. But that delay forced others to reassess their exposure. Questions spread faster than answers. Counterparties hesitated. Credit lines tightened. What should have been contained became contagious. Soon, firms that appeared healthy faced sudden strain. Assets could not be liquidated quickly enough. Promises depended on promises elsewhere. The system revealed its true shape. Not a collection of independent actors, but a single organism reacting to stress. London was about to learn that capital, when deeply interconnected, behaves differently. It accelerates growth, but it also accelerates collapse. And from that collapse, something entirely new would emerge. As hesitation spread, London's financial pulse began to falter. What had once been routine transactions now required reassurance. Lenders asked new questions. Borrowers delayed commitments. Intermediaries paused, uncertain whether moving too quickly would expose them to unseen risk. The city had not stopped, but it had slowed, and that hesitation proved dangerous. The collapse deepened when institutions realized how little insulation existed between them. A missed payment in one corner of the city forced adjustments across dozens of balance sheets. Guarantees that once felt abstract suddenly mattered. Collateral was reassessed. Valuations shifted overnight. Capital that had appeared abundant revealed itself as conditional. Merchants felt the impact immediately. Credit they relied upon for daily operations tightened without warning. Projects stalled mid-course. Goods sat idle as financing evaporated. The assumption that money would always be available, so long as paperwork existed, proved false. Confidence, once delegated to systems, had to be reclaimed person by person. Financiers scrambled to identify exposure, but the architecture they had built now obscured clarity. Obligations overlapped. Claims competed. Records told incomplete stories. The system had been designed for efficiency, not for unwinding. When pressure demanded reversal, complexity resisted. Rumors filled the gaps left by uncertainty. Some exaggerated losses. Others minimized them. Silence became suspect. Information arrived too late or in fragments. Markets reacted not to facts, but to fear of facts yet to come. Prices disconnected from fundamentals. Liquidity drained where it was needed most. Officials watched with growing alarm. Intervention risked signaling weakness. Inaction risked escalation. The city hovered between panic and paralysis, uncertain which move would cause greater harm. Every choice felt consequential. Every delay felt costly. What made this collapse distinct was not its scale, but its structure. No single villain existed. No clear failure explained the unraveling. The system itself had become the source of instability. Interdependence had erased buffers. Efficiency had removed slack. London stood on the edge of a realization it could not avoid. Modern capital required more than trust and innovation. It required resilience, mechanisms designed not just for growth, but for failure, and the city was about to be forced into building them. The tipping point arrived when several institutions attempted to protect themselves at the same time. Credit lines were withdrawn simultaneously. Assets were rushed to market together. What had once been manageable losses became overwhelming through coordination alone. London discovered that rational decisions made in isolation could produce collective collapse. As firms scrambled for liquidity, prices spiraled downward. Assets sold not because they were worthless, but because time had run out. Balance sheets shrank visibly. Confidence fractured. The city entered a feedback loop where fear created the very losses it feared. Modern capital, engineered for motion, now moved too fast to control. Inside counting houses, panic replaced calculation. Clerks worked through nights reconciling exposures that should have been understood long before. Executives faced decisions without precedent. Support one counterparty and risk insolvency. Abandon them and accelerate collapse. Every option carried consequences that extended far beyond individual firms. The conflict sharpened between those calling for intervention and those warning against it. Some argued the system must be allowed to purge its excesses. Others insisted that failure at this scale would destroy trust permanently. London had never faced a dilemma so stark. To act was to interfere with markets. To wait was to risk losing them entirely. The breaking strain came when one major institution failed publicly. Its obligations froze mid-transaction. Counterparties reeled. Markets halted. What had been abstract suddenly became undeniable. The collapse was real, and it was no longer contained. The city stood exposed, not to greed, not to fraud, but to complexity without safeguards. Modern capital had outgrown the structures meant to support it. And in that moment, London understood that survival required something radical. Not a return to the past, but a redesign of the future. The resolution did not come from a single rescue or decree. It emerged through necessity, shaped by the understanding that the old system could not simply be restarted. London's leaders, financiers, and lawmakers recognized that modern capital required new foundations, ones built not just to move money efficiently, but to absorb shock without tearing itself apart. The first changes focus on visibility. Institutions were required to map their exposures, not just to profits, but to one another. Interdependence, once hidden beneath layers of efficiency, was brought into the open. Capital buffers were strengthened. Liquidity was no longer treated as an afterthought, but as a safeguard. The system learned to carry weight without collapsing under it. Equally important were the mechanisms for failure. The city accepted that collapse could not always be prevented, but it could be contained. Structures were introduced to isolate distress, to slow contagion, to prevent one institution's fall from pulling the entire network with it. Modern capital gained brakes, not just engines. Confidence returned gradually, not the effortless confidence of unchecked expansion, but harder, earned trust grounded in resilience. Markets reopened. Credit flowed again, cautiously at first, then with growing assurance. London emerged altered, but not diminished. The collapse had stripped away illusion and replaced it with design. Looking back, the lesson was unmistakable. Complexity without resilience invites disaster. Innovation without safeguards multiplies risk. Modern capital does not fail because it moves. It fails because it moves without room to stop. From that collapse, London built a system strong enough to grow and flexible enough to bend. The city did not abandon modern finance. It learned how to survive it. So, what do you think? Are we repeating the same mistake again? The